Welcome to this film, where we're going to look at loan funding for creative startups and entrepreneurs. My name's John Holmes. I'm the Managing Director at Advantage Creative. So what we're going to cover in this film is types of loan funding, principles of loan funding, which one's right for me, a case study, and some resources. So types of loan funding break down into these: friends and family, personal loans, bank loans, startup loans, and loan crowdfunding. Let's look at each of those in a little bit more detail. First of all, friends and family. Now, many of the creative entrepreneurs I work with have had some element of friends and family funding in the early stages. It's always the first and the best place to go for affordable, flexible finance. And I always recommend you follow this route first if you possibly can. Often people say to me this is not a route for them, but I do urge you, think about this carefully. Let's say you want to raise £5,000. You might not have a parent or a friend who can lend you that much, but stop and think about it. How many friends and followers and fans do you have across all your social media platforms? Do you think you might know 5 people who could each lend you £1,000, or 10 who could each lend you £500? Often, I think the thing that stops us from borrowing from friends and family is embarrassment. So I urge you, try and get over that embarrassment. Believe in yourself, believe in your business, and don't be afraid to ask for backing. Reach out to your whole network of friends. Let them know what you're fundraising for, and let them know how much you need from each in an investment. Get out there and ask for support. You might be surprised. One tip: when you are borrowing money from friends and family, try to keep that financial relationship on a professional footing. Offer to pay interest at a reasonable rate. Put the agreement in writing. Keep up with your promised repayments. The next one is personal loan. So why am I including personal loans in this guide for businesses? Well, that's because a bank won't even consider your business for a business loan until you've held a business account for quite some time, probably around 2 years, and even then they're going to be very averse to risk. If you do get a bank loan in your company, then the interest rates are going to be relatively high, around 15% at the time of making this. So if you're in the first few years of building your business and you need to finance your business, a personal loan is often the quickest and most convenient and most cost-efficient way you can do this. A bank loan. As I've just mentioned, a bank will consider a loan, but only once you've held a bank account with them for at least 2 years, and you can demonstrate strong trading in your business. You'll also have to present a strong business plan that demonstrates how you plan to repay the loan. Most banks will also ask for security on the loan. So if you rent rather than own your own home, this can be another barrier. If you do get a business loan, it's likely to be at a higher rate of interest than a personal loan to reflect the additional risk. Startup loans. A few banks and lenders offer startup loans, and if you can get one of these, that's great. There's usually quite a detailed and competitive process involved. Only so much funding is available, and the lender puts you through a detailed assessment process to make sure you meet their criteria. They're looking for the very best startup companies that show the best prospects for business growth. Typically, these business loans, these startup loans, are at reasonable rates, around half that of a traditional bank loan. Now, at the moment, Virgin Bank and British Business Bank both offer startup loans from £500 up to £25,000. Also, Prince's Trust offer an enterprise programme for young entrepreneurs aged 18 to 30. This includes training, business support, and access to loan funding up to £5,000. When you're looking for loans or finance to get your business up and running, you might also come across startup grants. If you're a social enterprise startup, you can apply to UnLtd for one of their Do It Awards, up to £5,000. Local authorities and universities often run startup programs, offering a range of workshops, events, and sometimes startup loans or even startup grants of a few £1,000s. So research these in your area. I'll share these resources again later on in this film. Loan crowdfunding. There are a few crowdfunding platforms, for example, Zopa and Funding Circle, that specialise in companies raising funds. Their products include peer-to-peer loan funding and other more sophisticated types of lending. These all work to strict guidelines set by the FSA, or Financial Standards Authority. So you can expect to go through a really rigorous due diligence process where the platform will first check every detail of your company, its finance, and the credit scores of all company directors before you can even start raising finance with them. Keep this in mind because it'll take some considerable time and energy, and it's not to be taken on lightly. But if you need to raise quite considerably large sums of funding, let's say in the tens of thousands, then this may well be worth the time and effort for you. So one of the benefits of peer-to-peer loan funding on a platform like this is that you might achieve a better rate of interest than you might with a bank loan. Now let's look at some of the principles of loan funding. All of these types of funding have similar things in common. Interest. You're going to pay interest on a loan, and the interest rate will vary, mainly according to the risks that the lender is going to take. So at the time of making this film, you might expect to pay around 5% interest on a personal loan, around 7.5% on a startup loan, and around 15% on a business loan from a bank. So keep in mind, this isn't free money, and the sooner you pay it back, the cheaper it is for you overall. Repayments. You need to make repayments right from the start of the loan term. Now, if you're raising loan finance to scale up your business, there might well be a lead time of several months before you start to earn additional revenues. So you'll need to look at your business plan, and especially your cash flow forecast, to work out how you're going to afford those repayments and how much you're going to repay and when. Risk. Now, the lender's task is the management of risk. Any bank or institution will gather information and weigh up the risks involved in lending to you. The higher the risk, the higher the interest rate. And the risk is too high, the lender will refuse to offer you the loan. And security. Now, an unsecured loan is one that is not secured against any assets that you own. So, if the worst comes to the worst and you can't repay the loan, the bank cannot take away your assets. It is possible to get unsecured personal and startup loans up to around £10,000 and occasionally up to £25,000 in this way. Usually, however, once you start borrowing funds in the tens of thousands, the lender will require security against the loan. For people who own their own house, even if it's still on a mortgage, this is usually the way they provide security. But if you don't own your own house or have any other assets you can offer to secure the loan, then you can find it difficult to get a bank loan at this kind of level. So what's the right kind of loan funding for you? Well, if it's short-term, get-me-by funding, you want just a little bit of finance for a short spell, then go to friends and family. Look at a personal overdraft or even borrow on your personal credit card. You want something that's a real quick short fix. If you're looking at startup funding, then see if you can get a startup grant or a startup loan. You can also look to friends and family or look at a personal loan. But if you're scaling up your business and you want to borrow more money, then you're most likely going to look at a bank loan or possibly loan crowdfunding. So now we're going to look at a case study. Denise O'Sullivan set up her own ceramic design business, Denise O'Sullivan Ceramics, on a small scale with some support from friends and family. Her dad lent her the money to buy a kiln and he set it up in the garage. In the early stages of growing her business, Denise kept on her part-time jobs and she was selling through her network, through the cafe where she worked and in a museum shop where she volunteered. Denise got accepted onto the Prince's Trust Enterprise Scheme, and through that she had help with a business plan training and also a business loan of £3,000. Now this really helped her show her work at trade exhibitions. Now taking on a business loan at this time was exactly what she needed to take her business to the next level. She knew she needed to get in front of trade buyers to grow her business, and she was successful in that. Looking back on it, this is what Denise told me. Having a loan rather than a grant really helped focus my mind on earning money in the business. It helped me sharpen my business skills. So the loan funding was right for Denise because she needed a small amount of funding to get the business started. She had a clear plan in mind as to exactly how she was going to earn income to repay the loan, and she wanted to retain 100% ownership of her company. Here's some of the resources that can help you if you're looking at loan funding. Thanks for watching. Check out our other short films at our website.